Ladies and gentlemen, thank you for coming back to Marathon Money Inside the Ticker. And we have another one for you today. And I personally did a lot of research on this company. And obviously, you can see Joey, the co founder of TNMG. That's the ticker symbol on the NASDAQ. But they're out in Taiwan. And I think they're undervalued, undiscovered, and I believe a lot of people will be happy with what they hear today and what they found out on their own. So I'm gonna let Joey start off with introducing his company.
Thank you, Kenny. Thank you for having me. We're based in Japan, Taiwan. We have 5 offices across Tokyo, Kyoto, Taipei, and Hong Kong as well. But we set out to create the largest pan-Asia, multi-language, multi-market, independent, high-quality media, but also tech, data, AI, e-commerce, that entire digital ecosystem. We now, in total, have about 40 to 50 million monthly unique readers from the media side of the business, 25 different media brands across Japanese language, Chinese, and some English and Cantonese, everything from Business Insider Japan, Gizmodo Japan, Digiday, Business Insider Global Chinese Language Edition. So everything from serious news, finance, gadget, lifestyle, movies, entertainment, across multiple languages. But at the same time, we've also diversified over the past few years to also start gradually acquiring different MarTech, AdTech, big data, AI algorithm, and e-commerce companies as well. So even though we started originally as a pure media play in Japan and Taiwan, we've gradually done a series of acquisitions. We've done a total of 11 or 12 acquisitions over the past 5 or 6 years, to the point where we kind of naturally evolved from being a pure media play to being one of the largest digital media groups, and to then evolving into one of the largest digital media, but also tech, data, AI, e-commerce, that entire digital ecosystem. So that's kind of where we are over the past 11 or 12 years. There's a TNMG in the title because our largest merger was actually 2 years ago, where we merged with the largest Japanese-based digital media group versus us being one of the largest Taiwanese-based digital media and also tech and data companies. So that's why it's kind of like a merger between the last 2 large acquisitions between Japan and Taiwan. But to kind of re-summarize. 40 to 50 million readers. That's the digital side of the business. 5 offices across Asia. Close to 200 million page views, and 1/3 of our revenue now is media advertising. 1/3 is actually tech and data analytics, and 1/3 is other digital studio campaigns, e-commerce, and paid events. So kind of natural, I guess, 3 stages from pure media to being a large media group to being now hopefully one of the largest media, tech, data, and AI plays across Asia.
I love everything I just heard, to be honest with you. This is kind of companies, I think you're like the media conglomerate that a lot of people try to get involved with, definitely investors like myself. So the first question that really comes to mind, you're acquiring these companies. This is where I kind of want to see where your leadership is at. It's like, what things are you seeing in these companies that make you want to acquire them and that makes them a good fit into your company that will bring ROI?
Sure. I think there are different stages if we kind of dissect that question. So initially, we started with 1 or 2 independent high-quality media brands. So kind of to take a step back, the original ideal was to create high-quality, no fluff, no junk, no political bias, no corporate agenda, only high quality newsworthy content. That was the original ideal when we started 11, 12 years ago. Once that kind of became one of the largest, fastest growing independent serious news brands digitally, we thought it's time to start being kind of a digital media group. So to answer your first part of your question, so we started acquiring, for example, tech media, sports media, gadget media, to really kind of become more of a 360 all-encompassing media content service. So that's why we got to 25 different media brands. And then once we got to 10, 20, 30, 40, 50 million readers, we thought it was time to start investing in the other complementary tech, data, AI, or e-commerce companies that would allow us to make money and monetize on all the readership data that we're collecting now at a certain scale. So again, to answer your question, initially when we started doing these M&As, there were other smaller media groups. There were other tech verticals, sports verticals, finance verticals that we thought fit the DNA. Again, high quality, no fluff, no junk, no political bias, only newsworthy content. So that was the criteria in the initial stage. And then as we got enough readership scale, that naturally evolved so that the acquisition targets had to be a large enough scale as a media company or a large enough scale as a tech, data, or AI company that will help us monetize on the data that we're gathering. So this latter half of that kind of became we're acquiring tech, data, or AI engineering teams to be able to help us monetize on the left side of all of these readership that we're gathering. And I would say finally, now when we're looking at different acquisition targets, they kind of have to fulfill all 2 or 3 of that criteria. They have to be big enough as a media group. It doesn't make any sense for us to spend 6 months to acquire a media vertical now that only has 1 or 2 million readers if we already have 40, 50 million readers. And on the second end, from a revenue standpoint, they have to contribute substantially enough to the revenue, and ideally they would be profitable themselves already. So it kind of has to fulfill that 3 criteria: certain scale to move the needle, certain scale in terms of revenue, but also from an EBITDA standpoint, it needs to be positive as well. And we can take that, plug it into the existing group, and then immediately create synergies where we can immediately start funneling, creating more readership, send traffic, content cross-pollination, content translation, immediate use of the media part of the business. Or, for example, they are a tech, data, or e-commerce company that we can plug in to that aforementioned 30, 40, 50 million readers and increase their monetization faster, make their services more precise, make their big data more precise, and create that positive flywheel where it allows the AI or engineering team to make money faster, and that allows us to invest in the next media expansion, and we go from 40 to 80 or 100 million readers, and then allowing that data to be integrated with that tech and data play, thus kind of finalizing and finishing that positive flywheel. So that's kind of like the natural evolution over the past few years.
So, see, as an investor, as a trader, I like what I heard. So to me, you already have a formula that's been working for you 11, 12 times already. Am I correct? And
Yeah.
that formula is very, very precise. So what is the lowest? I don't want to ask the highest return of investment, but what is the lowest return of investment that you would say is like, you're getting 20, 30% or even 15% at one of these acquisitions that you can tell us?
Sure. I think the easiest one that comes up to mind is, and to be very brutally honest, of course, if we kind of go back to that last question, we started first acquiring other media groups, and then we started acquiring the tech and data or monetization products to make money on the media groups. I would say, in retrospect, over the past 5 or 6 years, the more lower return on investment recently has of course been some of the media acquisitions, because with the recent AI, with the AI SEO disruption, and the fact that all of these media plays are now kind of going down in terms of page views because they're being disrupted by Google AI, by ChatGPT, in the sense that many people now don't go directly to the publisher's website, they just ask AI or they just ask a chatbot. So it seems like right now the media advertising part of the business is, I guess, the question mark in that sense. What's the future of that? Are we still in that previous business model era where 40, 50 million monthly uniques, 200 million page views is sustainable? Will it continue to be that way, or will that return on investment decrease rapidly because of this AI disruption? So I would say, I guess, the name of the game right now is, I would not be surprised if right now the revenue breakdown is 1/3 media advertising, 1/3 tech and data, and 1/3 digital campaigns or e-commerce or agency services. In the next 2 to 3 years, we actually kind of naturally evolve again, where media advertising might be 25%, 20%. The AI and tech and data analytics might actually become 50 or 60%. And then the others, the e-commerce or the digital campaigns and studios, also becomes 20%. So I think that will probably be the next natural stage of this evolution, where we increase tech and data or AI services becomes a natural revenue driver, and we need to quickly diversify away from purely depending on page views, depending on traffic for media sales.
Can I confidently say that you guys already have a plan to adjust for that, or you guys are already adjusting for that? Can I confidently?
Yeah, we're already adjusting for that. In fact, if you look at the H1 numbers results that we just announced about a week ago, like we kind of guessed, I mean, it's the same for everyone. Media sales is kind of going down or plateauing or flatlining, but tech data analytics has actually increased rapidly. So I think, yeah, again, for us, probably in the past 5 or 6 years, the name of the game has been diversification. How do we diversify from just one or two media brands to being a media group? How do we diversify from one language to now 3 or 4 languages? How do we diversify from one vertical to 25 different verticals? And finally, with all of this AI disruption and all of these macro factors, how do we diversify from one business model that was 5 or 6 years ago, 99% media sales, to now media sales, tech and data, AI, e-commerce, so that in any way we're kind of all hedged against whatever macro downward trend because of AI or politics or timing and all that stuff.
I do have a question though. You guys are big in the Asia market, huge. I believe you guys already have kind of a roadmap because I know you guys already touched some of the U.S. market. Is there a bigger plan or a bigger play to get more deep into the U.S. market, make an acquisition there?
Sure. Right now, our largest markets are, of course, Japan, Taiwan, Hong Kong, and some Southeast Asia. Interestingly, the U.S. is actually our 4th or 5th largest market right now in terms of readership base. And that's simply because wherever there's a strong overseas Asian population, so, U.S., North America, Canada, UK, Australia, we actually have a lot of existing natural organic readership base there already. But that being said, yeah, I think the short answer is we've always been open. Most of our acquisitions so far have been Taiwan or Japan based. And if we're already very strong in this part of Asia, Southeast Asia will be our natural, I guess, next target in terms of possible acquisition. We want to be able to finish Southeast Asia. It could be Singapore, it could be Indonesia or Vietnam. But the idea is very, very soon, we want to finish the Pan-Asia story. We want to be able to say we're the largest de facto Pan-Asia, multi-language, multi-market media, but also tech, data, AI, e-commerce, that entire digital ecosystem, one-stop shop. But to answer your question, ever since we started doing acquisitions 5 or 6 years ago, every now and then we would get serious offers about U.S. potential targets. It could be a major U.S. media acquisition target. It could be a major U.S. tech or data or AI engineering team to, again, make money on the readership that we're collecting with that positive flywheel.
Before you go forward, is it the reason why you're not those offers that people? Because I believe I'm in the also in the private equity space, but I do believe are they not meeting your criterias? Because then that sounds very confident to me if they're just not meeting your criterias, because I know your revenue is high and you guys are making good money. And so do they not meet your criteria, the stuff that are coming out of the US? Is that why you're not choosing them?
Well, I mean, naturally, if we're going from Japan, Taiwan to Southeast Asia, that's kind of our first tier priority for now. So we're not in a rush to have to acquire someone in the US for the sake of acquiring them. That's number one. Number two, going back to that 3 criteria, they have to be a certain scale, they have to be a certain revenue, and they ideally have to be profitable themselves to be able to contribute to the entire group's operations. It's been hard to find a perfect target that fits all 3 criteria that at the same time is a good deal that we can afford, et cetera, et cetera. But I would say the third final answer to that question is it has to kind of fulfill that, why do we feel this target is perfect for us, that we need to definitely acquire them. They are the perfect target at the perfect timing. Something is usually missing, right? Again, we're kind of naturally conservative when it comes to making safe acquisitions that have synergies and are already EBITDA positive. So we don't want to do anything that's for vanity. We don't want to do anything just to say, oh, we have New York or California on the map. If it fulfills that 3 criteria, if it's the perfect timing, and if something we can feel that we are confident in that it's a good fit and we're able to integrate it, sure, we'll definitely consider it. But over the past 5 or 6 years, we just haven't come across the perfect partner that we feel, oh, it has to be this target, is the perfect fit across all the different alignments. And we don't want to do that just for the sake of vanity, just for the sake of face and saying that, oh, cool, we now have a New York office full of 50 people, but it might be bleeding, a couple 100,000 every month. And it's more of a vanity project that we won't be able to sustain in the long term. So it needs to fulfill all of that. And as you can imagine, it's not a perfect timing, perfect fit, and not easy to do that sometimes.
And the reason why I ask you that, because as me, if I'm investing into a company, I don't want you to take unnecessary risk that's not going to push you forward. I know sometimes things take time to get the return of value, but if you're, like you said, if you're just doing it for vanity's sake, you're just going to end up in a situation it's going to be worse, and that's where dilution comes in. So that's what I'm looking for. So when I say that, I like what you're hearing, like not taking unnecessary risks. What's your criterias? I like all that stuff, because to tell you the truth, when I hear all those things about a company, that tells me, okay, they're not going to make any decisions that's outside the realm of their comfort that had made them successful in the past. So my thing is about what leads me to is transparency. Are you guys going to start filing more to for the US market shareholders, investors to be like, okay, they're transparent, this is what they're doing? I understand the criteria. I think people listening to this going to understand your criteria, and you're kind of moving the same way as a Warren Buffett move. Diligent, not taking on unnecessary debt. So what about filing? Are you going to be more transparent about filing more? Because you guys are overseas, and that's kind of like a concern for us, the people, the investors, US.
Sure. Yeah, that's definitely the direction that we're ideal heading towards. So, this is our first year as a public company. We're less than a year old. We're only about 10 months-ish old as a public company. So we're still kind of learning the ropes as we go. And as you accurately mentioned, we're kind of far away. So we're trying to play catch up as fast as possible. You can tell from, for example, we just released our H1 earnings last week. And we've been really upping our press releases to be as transparent and as communicative as possible to our target audience in the US, to kind of allow investors to know who we are. I mean, you can easily imagine, if everyone already knows who we are in Japan or Taiwan or Hong Kong, your average retail investor definitely has no idea. They are definitely not originally a reader or a user of our media or MarTech or AdTech part of the business, then we have to try double or triple as hard to basically communicate who we are to the market. And that's what we've been trying to do. So if you look at our past 8 or 9 months, when we first went IPO, we were very silent for the first 2 or 3 months. And hindsight, that was probably a little bit too conservative on our end. And then we hired an IR firm. We started doing interviews, roadshows, non-deal roadshows, one-on-ones. And over the past 3 or 4 months, we've been really upping the frequency of which we've been doing, like these interviews with you, Kenny, other interviews with different influencers or financial programs or podcasts. And on average now, for example, we're issuing press releases almost 2 pieces per week to really, again, introduce ourselves to the market, to say we're here. We're definitely not, a tiny little company in Asia or a scam or something that's not serious. The Japan part of the business has been operating for 26 years. So just imagine the Japan part of the business, when we merged with them, they were the largest Japanese native digital media group in Japan for the past 26 years. The Taiwan side of the business was the largest Taiwan digital media and data group in Taiwan already. So we're definitely a serious business, but I guess the opposite side of that question is most people in the US or international investors don't know who we are. So we've been trying very, very hard over the past 4 or 5 months to get our story out there, to introduce ourselves to the market. And so to answer our question, filing more press releases, more interviews, and programs like this are definitely in the horizon. And we're already in the process of doing that.
That is what you're saying is, doing more interviews, more filings, even press releases, even articles that you guys are doing, even hearing your voice, really gives investor confidence. It definitely gives me confidence, because you're constantly putting your company out front, because that, to me, that also gets people to look into your company, subscribe, get newsletters, be a part of what you're doing. So, to me, when you're constantly doing that as an investor, it does build that confidence in me and in others as well. So to segue into a question, so how are you acquiring customers? How are you doing that? How are you getting people to those 50 million readers? How is that happening?
Sure. So I would kind of break that down into 2 or 3, segments as well. So the media part of the business, as you can imagine, in the US, there might be, Vox, even your New York Times, BuzzFeed, et cetera, et cetera. So you have your natural digital readers, your natural digital subscribers from the get-go. And as you build out your brand reputation, your brand equity, you kind of snowball more and more readers. And then once you have 2, 3, 5, 10 different media brands through social media, through its own content cross-pollination, or you're sending traffic to each other, you'll naturally create a snowball effect where your tech media can refer traffic to your gadget media can refer traffic to your finance media can refer traffic to your lifestyle media, for example. And then you take that and you times many times across, Japanese content can now be translated through AI into Chinese or into English. So even your existing, low-hanging fruit Japanese content, you can pick and choose what you think would be the most relevant, or based on data, what is already most popular in Japan and most relevant, and translate that and send content and send audience into the Chinese part of the verticals. So there's a lot of ways you can kind of cross-pollinate and send traffic and refer traffic to each other. That's, I guess, one part of the question. The second part of the question is, once again you have a loyal audience scale of 10, 20, 30, 40, 50 million readers, your advertisers will come find you and say, oh, we want to do media buy. We want to do media buy across 5 different verticals, across serious news, finance, gadget, or lifestyle. And once we have them as a customer, and then we start upselling and therefore also more diversifying. Oh, do you want to also do data analytics? Do you also want to do e-commerce? Do you also want to do paid events, a paid subscription, or MarTech and AdTech services? So just to give you an example, if 5 or 6 years ago, one of our large clients came to us and we only had media buy, they could say, oh, okay, we'll spend 30,000 USD for media buy, but it's just programmatic, it's advertorials, it's campaigns, that's it, 5 years ago. Now, when we go to that client, we can say, what do you need? We can basically be the one-stop shop for all of your digital transformation needs. So if you want to still do media buy, we now own 25 different media brands. Do you want to do media buy across Japanese, Chinese, English? Do you want to do targeted media buy in finance media or lifestyle media or gadget or sports media? We own all of them across all of these different languages. But on top of media buy, before and after, do you need to do market survey? Do you want to do big data market research? Do you want to do mobile ad tech, data analytics, data exchange, or AI algorithm services? 5 years ago, this company would need to go to 5 different companies for those services. They can now just come to us, and that creates that stickiness of that snowball effect, where we're basically their one-stop shop for all of their digital needs. So to answer your question and re-summarize again, on one hand, more and more audience, more and more readership base, and once you have a certain scale, they're able to kind of cross-refer, and create more and more audience and more stickiness. That's the B2C side. But at the same time, once you have 30, 40, 50 million readers, you're able to package bigger and bigger, media, tech, data, e-commerce packages, and also have stickiness with your B2B clients as well, and create that positive flywheel, if you will.
Your moat was very wide. I really like that.
Actually, exactly. Two moats. Yeah, more and more readership. That's one moat. And more stickiness for our P2P clients. That's the second.
Exactly. Very, very, very good. Very, very good. I really, really like that. And I kind of want to shift to like submitting some of the audience that have sent me some questions. And I understand maybe some of the questions you can't answer because of SEC rules, but if you can't answer, just say no comment. What is the current status of the earning out shares issued? How many remaining unissued, and what does dilution risk looks like for investors?
Sure. So I think on a rough range, we have about 30 to 40 million shares, very roughly. And in terms of registered shares, probably a couple of million in the low side of that range. And that's for upcoming possible fundraising targets. Let's kind of generally put it that way.
So dilution risk is very low. I'll take it.
Yeah, it's, I think, relatively normal. Yeah.
Thank you. Also like licensing, what percentage of revenue is depending on licensing brands?
Well, we own 25 different media brands. Of them, only about 3 to 4 of them are actually licensed. So Business Insider, Gizmodo, Digiday.
Yeah.
So 3 over 25 in terms of rough revenue breakdown. Of course, Business Insider is bigger, but just very, very generally, I would say 10, 20% of the revenue, probably 10% is tied to licensed brands. But on that note, we have a very long-term relationship with the licensees. With the licensor holders. So I don't think there's any risk at all of us losing those licenses in the foreseeable future.
Okay. Man, this is kind of getting close to the end of the show, and this is one of the things I ask. What are like the three, let's just say 2 or 3 catalysts we can look for in the next 3 to 4 quarters? Like more acquisitions, or you guys have bigger growth coming. What thing we can look for? You guys are going to enter a new market. What things we can look out for that we can be tethered to the stock longer to see like true growth on a consistent basis in the next 3 or 4 quarters?
Sure. So the previous average in terms of our execution plan, very broadly over the past 5 or 6 years, has been to maintain healthy organic growth anywhere between 15 to 25%. So that's organic growth every year. And on top of that, on average, 2 acquisitions every year. So that's been kind of the rough average over the past 5 or 6 years. Again, we've done 11 or 12 acquisitions over the past 5 or 6 years, so on average, 2 every year. The goal was to actually continue that in the foreseeable future. Now, of course, as a public company, we can't guarantee that. But to answer a question, how do we continue that story and again finish Southeast Asia to be able to finish again the Pan-Asia story, to be able to execute on the next 1 or 2 acquisitions? Ideally, they would be anywhere in Asia or Southeast Asia. Ideally, they would be one possible media play, one possible tech or data play for the monetization efforts. And that's kind of the roadmap, the broad roadmap we want to continue executing for the next few years. That's number one. Number two, as I guess we discussed, since we're relatively new on NASDAQ, no one knows who we are. We're trying to get our story out there, so we're way undervalued. And so I think the focus for us over the past year has been how do we get our story out there? How do we really lower our debt that was accrued during the IPO process or the de-SPAC process? So really prove to the market that we're serious, really prove to the market that we're almost done with this initial stage of getting out of that de-SPAC small IPO initiation process, and prove that we're a serious company. Debt level is now very low, or back to market norms, and really start getting our story out there so the stock price can appreciate in a way that we feel kind of reflects the market kind of knowing and understanding what we're doing. So I think the second part of that answer is basically just to really truly introduce ourselves into the market, truly get our story out there as transparently like this as possible, to understand what we're trying to do and trying to execute. That would be number two. And I think number three is ideally we've kind of evolved again over the past 10 years. We went from a pure media play to being a pure media group to then being a media, tech, and data and AI company. As you asked in your first 1 or 2 questions, very soon in the next few years, I would not be surprised if we gradually evolve and gradually add on more and more of that outside piece of the puzzle, where in the middle part, it's still, media, 30, 40, 50, 80, 100 million readers. But we're adding more and more pieces of the puzzle on the outside. We're adding MarTech, AdTech, e-commerce, data analytics, AI algorithm services. So we will add more and more other potential business models or units or monetization efforts that make sense to be plugged into 30, 40, 60, 80, 100 million data sources. And so I think something to look forward to is, again, I would not be surprised if in a few years we kind of went from being a pure media play to being a majority tech or data or AI algorithm services play that is still tied to the original media play as a data source part of the business. But then the narrative becomes very, very different. We've kind of naturally evolved and kind of changed the story every 3 to 4 years. And I think that's also coming up in the horizon very, very soon, hopefully.
And I'm going to end it on that note. I really like what I hear. I really got a full grasp of understanding what your business is about. You guys are trying to really become a global dominance, and you guys are really doing it step by step to make sure every brick is secured. I can confidently say that. But Joey, I look forward to in 6 months for you to come back on here and hear some good news. See what other acquisitions you guys require. I know maybe it might not happen because I love you guys' criteria because and I'm pretty sure I is very trusting to hear somebody's criteria and they're not going to make a move unless it is a good fit for the business overall. Um, what is like? Is it 200 million readers? 200 million viewers? What is it? 500 million? What is like the 5 year goal? That's really like my last question. Like, you guys have a 50 plus million right now. It's like, and all with these new pieces and other pieces that you guys are planning on adding, it just seems like there might be an end goal to like 500 where you guys have some tipping point dominance.
Yeah, well, 500 is huge. I would say, I mean, not to, again to put too much exaggeration in this just yet. If we're at like 30 to 50 million right now, just in terms of the tangible, next few goals, I would say anywhere between 70 to 100 million readers in Asia will make us one of the de facto largest digital media part of the business players in that region. So I think that would be a fair near-term goal, number one. But number two, with again all of the AI disruption, all of the media, changes every few months now in the industry, to truly be safe. And really kind of protect the original part of the media part of the business. I think the other end goal is to be diversified in 3 to 5 years, where it's not even 1/3, 1/3, 1/3. It might be 50% tech and data, 10% media, 10% e-commerce, 10% agency, 10% events, 10% paid membership, to the point where our business model, unlike many different media plays, is finally not restricted or bottlenecked by how many page views or how many readers you have. I think that was the tricky thing over the past 10 years. Everyone was going after page views. Everyone was trying to hit 1 billion page views. But every time there's an algorithm change, every time there's an SEO change, an AI change, everything goes down. And so we want to kind of diversify, integrate, and create synergies and hedge against each other to the point where in the next 3 to 5 years, we'll always have a core 40, 50, 60 million readers. Yes, but at the same time, on the outskirts, we've diversified our revenue and business models so much that we're not dependent. Our entire group's livelihood is not dependent on trying to chase after or generate as many page views as possible, but they're all kind of fully integrated and go hand in hand. I think that would be the dream ideal end goal here.
That would be amazing. I feel like creating that kind of diversity will also create profitability and keep you like basically creating a safety net.
Yeah, that's the
So
goal.
I really like hearing that. And guys, we're at the end of the show. I appreciate Joey coming on here. Remember, ticker symbol TNMG. I appreciate y'all. I appreciate y'all listening. I appreciate Joey coming on. One thing you want to say before we end the show, Joey, to the potential investors out there.
Yeah, I mean, thank you for having us on the show. This was very, very enjoyable. But I think just to again emphasize, we're very much a serious business in Asia already. We're a new kid on the block in the US, of course, on NASDAQ, of course. But I think we have a very proven track record of taking this very, very seriously, of executing cross-border, multiple acquisitions, multiple operational milestones. And we are really looking forward to having the opportunity to kind of also prove that, to US investors, to US markets this coming year and very, very soon as well. So hopefully this is the start of the first step and a very, very good start as well. Thank you for having us on.
This is Marathon Money Inside the Ticker. Peace.